Welcome back. Let's talk about the Indian markets. Rohit Srivastava, founder strategist of Indiacharts.com, joins in to discuss the way forward. Rohit, early this week, we were thinking that markets are likely to break out. There was so much momentum on the way up, and that suddenly turned, right, from yesterday's price action and today the way markets have fallen more than 150 points. So still very much back in that trading range. Your thoughts on the way forward?
So the action that we are seeing in the US does raise the potential risk that can the market really fall some more from here. If we break, say, 17,300, we would have to open up to the idea that we can slip towards 16,900. But I'm not putting a certainty on it. The thing is that the market sentimentally has been, pretty oversold because when we generally look around, sentiment is the most bearish that we have seen in years. And beyond that, if we think about when this entire trading range, not just the short-term one, but the longer-term one really started, it takes us all the way back to October 2021, right? That's where the market started to gyrate in both directions. And we have seen after that even one new high and then this sell-off. So the period that we've completed is around 18 months, which is sort of equal to what we spent post Y2K from the peak of March of 2000 till October. And just inverting the months, starting from October, now we are in March of 2023, 18 months later. So we are sort of at the end of a time, sufficient time for a bear market to complete. We are also at the end of a period where sentiment has turned extremely negative. So sort of the setup is not one where I would be comfortable turning too bearish. It's possible there are some short-term gyrations. I think over the last month, twice at least, we have seen the index break to a lower low from 17,800 to 17,350 and then to 17,250. So if we do break 17,300, can we drop to 16,900? Sure. That's around a 200, 300 point downside risk that can open up. It hasn't opened up yet. But on the other hand, we might just be reacting to global cues while this might be just a bottoming out phase, because you can see the relative strength of either the Indian banks, because the bank Nifty is actually not made new lows compared to the Nifty in the last month. We also see the similar relative strength in the mid and small cap space where, individual stocks are still holding up well. If you look at the strong sectors like, defense, capital goods, many of these sectors are actually holding up pretty well compared to the Nifty. So it doesn't really look like this is a panic, sell everything and go home situation. We are reacting to global cues, but it still remains a bottoming out market from a slightly longer term perspective, keeping some short-term risks open if we do break certain levels, but otherwise it may just be basing out around here. Two of the big macro factors which I think have scared everybody, we can look at both in the US and India, has been the 10-year bond yield, right? So you have seen the US 10-year bond yield jump. In fact, the 2-year bond yield, not even the 10-year. The 2-year bond yield really jump up over the last couple of weeks. But last 2 days, you've seen it actually ease, especially after yesterday's negative news flow. And you've not really seen the long bond, which is the 30-year, fall along with the 2-year. So while you had 2-year yield jumping because the 2-year bonds are falling, the 30-year was not accompanying it. So that's an intermarket divergence typically seen at the fag end of a move. So what I'm really trying to say here is that the jump in US interest rates in the 2-year yield, which has been creating a lot of the scare right now, is at the fag end. It may have, in fact, even peaked in the last 2 days. So you might actually see bond yields start to cool off. They'll probably not go beyond this 5%, 5.25% mark. And that will sort of ease pressure on the markets. We didn't see that yesterday because of other news related to a particular bank failure.
Your commentary
but
seems
otherwise,
to be,
I think
your commentary seems to be working like a balm on the frayed nerves of the market right now. We're back above that 200-day moving average on the Nifty. We have recovered a fair bit from the lows. Of course, it's been a tough day, but still down 150 points on the index. A good 80, 90 points off the lows of this morning. We're doing fairly okay-ish from in the last 15 minutes or so. Just wanted to understand your thoughts on the Nifty Bank. That was underperforming a fair bit. Do you have any levels that one should be watching out for on the Nifty Bank?
So the Nifty banks actually held most of the recent lows. In fact, it's not even gone below the low that it made on the budget day. So if I actually look at the budget day low, which is around 39,400, then it got followed by a low of 39,600 in the end of February. So I think unless these lows really break, that's the bottoming range. If I look at the weekly bands there, and since we are closing for the week today, that's actually at 39878. So unless we really close below 39878, I think this is the bottom end of the range. So, that's the risk versus the upside. Once we do base out here and start up, the upper band for the market could be, Bank Nifty could be around 43,800.
Okay, got that. Rohit, the one space that you really do like is the metals, right? We've spoken about this many times on the show, and we have seen a bit of a recovery come through this month, at least not a bit. I mean, it's recovered a fair bit. Do you think this is something that's likely to continue also in the light of what's going on in China, the data suggesting that there's a recovery playing out there as well? Do you think the metals pack will stay firm?
I think so. We have seen a short-term correction, say, in copper prices. We are still seeing some weakness in aluminum prices. Steel prices are holding well. Yeah. I think the next 1 week is probably the volatility period, because everybody's watching the Fed and trying to figure out what will happen to the dollar, which is the main constituent that drives the metal index, because metal prices are driven by where the dollar is really headed. My sense is that there's good support in most of the metal prices. They are at their lows. And in fact, metal stocks themselves have retraced fairly well, around 50% of the gains that they made between June and December, which puts them in a pretty good place to resume the upward trend. Give it a week, I think, for it to stabilize around the news flows related to the interest rate position. Once that is done, I think you should get a fairly good rally in the metal space.
Well, thank you very much for joining in. Need to get into a break. We'll discuss commodities on the other side. Manisha Gupta joins in next.